Welcome to the daily update, where I'll go over the action in the market for Wednesday, January 29th, and we'll see how things look for Thursday, January 30th. Okay, the Fed came out. They said what they wanted to say. The market kind of tried to gyrate, but we ended a little bit lower. Now, we're seeing some weakness coming into the market. Is this just pulling back from being extreme, or are we seeing signs of a switch over to things looking more negative? Right now, you can make a case for either side. We're still looking positive, though, in the short, intermediate, and long term, but we're seeing that weakness kind of creeping in. There's really not much of a trend going on right now. The ADX is still positive, so we can also default to that, but we'll just, we need some buying to come back in to really turn things back more positive and actually drive the indexes higher. All right, let's go back and talk about what happened. We had a lower open and things were pretty quiet. So that's usually how it is. We have a bit of a gyration at the open and then things settle down and then the Fed comes out with their announcement. We declined down to the daily pivot at 6,046, and that's kind of the midpoint. And even though we were negative at that point, how this is calculated above the daily pivot is considered positive, below the daily pivot is considered negative. Then we actually got down to S1 at 6,017, and then we climbed back and started to stabilize right about at just a little bit below the daily pivot. Then the announcement came, and they didn't change rates, and that was not a surprise. It was what were they going to say? We got back down to S1. This is the typical post-announcement gyration. And then we rebounded back up to the daily pivot, and we closed slightly below the daily pivot. And yes, how many times can I say daily pivot in one sentence? All right, we were down 0.747% on above average volume. Typically, volume will pick up on days like this as folks are squaring up some positions and having to react. As I said, we're still positive in the short, intermediate, and long term. We could be working off some extreme conditions, but we want to respect that at the same time because we have a few indicators that have been negative. The Swenlin trading oscillator, it started to go negative last Friday. It's still going down. And some of the extreme readings that we were getting are starting to wear off. So we just want to pay attention to that and say, okay, can we turn around and go back up, or is this the beginning of more weakness coming into the market? All right. So some comments. Microsoft and Tesla, they traded down after the close. They came out with their earnings, and Meta was higher. Apparently, the list I was looking at was incorrect. I had Amazon reporting this week. They don't report until next week. But these are three really big companies, and they can have a real impact on how things go. Initially, Tesla was a little bit higher, but then it ended up dropping lower. I just took a quick look at their after hours prices. Small caps are still below their 50 period moving averages. They were down again. They're not performing like everybody thought they would. They're just kind of hanging out, not really showing an awful lot of strength. And that could be due to interest rates being higher. That affects their bottom line. And our short-term list getting a bit shorter. We have one part of the stochastics chart, but on a momentum basis, we're still positive, and the short-term slope oscillator is still looking extreme. In the intermediate term, we actually came down. I should have taken this off the list. The advanced decline line based on 10 periods, it's actually coming down. This is one of the things we want to keep an eye on. Sometimes when this shifts and goes in the other direction, that starts to happen before we see it in price. So now it could turn and go back up because we were getting some very high readings with this indicator. We just want to pay attention to it. The Sean trend meter, the PMO studies, and then the Chaikin oscillator, which continues to go up. The smart money indicators that we have are looking really good right now, maybe a little too good. All right, and then this is another thing just to keep in the back of our mind. We have this indicator called the mass index. It's triggered now. There are three criteria that need to be met. Those have been met, and that is trying to suggest a reversal. So again, we don't base everything around this. We just respect it and realize, okay, this is in the picture now and has been. This is the second day now that we're seeing this. And at their last meeting, the Fed did cut rates a quarter of a percent. They didn't cut them at this meeting. They are still getting a little bit more concerned about inflation. The dollar was up and interest rates were up, not very much. We closed at 4.56% with the 10-year yield where we had been at 4.55%. Sentiment actually ticked up a couple of notches. We're neutral right now. We're at 46 where we had been at 44. Once we get above 45, that's the neutral category. And we're still not trending. The ADX is below 20. It's below its moving average, but it is positive since the green line is above the red line. I kept our bias, or I changed it to mixed because we didn't really go down all that much. And that's usually what I base bias on. But with the smart money indicators actually advancing, that's why I decided to go with mixed. Momentum, we're still mixed to positive. We just want to be aware that some potential weakness could be starting to come in, and I'll show you that as I go through the charts. So here's just a breakdown of the announcement. They left rates unchanged, so we're at 4.25 to 4.5, and this was not a surprise. And then the thing that came out of what they said is what they didn't say. They didn't have the line, inflation has made progress towards the committee's 2% objective. Instead, they said inflation remains somewhat elevated. And if anything was negative, it's like, okay, you didn't say this inflation is doing better now. We're going to take that a little more negative. All right. And then, which wasn't too surprising, and because they didn't expect rates to go down, and the labor market is still fairly strong. Now, next week, we're going to be getting the employment situation report on Friday. And then in the press conference, Chair Powell came out and said the broad sense of the committee is that we don't need to be in a hurry to adjust the policy stance. All right. So the economic reports that came out, we get this every week. The MBA mortgage applications, it was down 2%. Last week it was up 0.1%. And these I don't have charts for. The advanced international trade in goods minus 122.1 billion, lower than what we saw last time. Retail inventories were down 0.3%. Last time they were unchanged. Wholesale inventories down 0.5%. Last time they were down 0.1%. So this is the chart that we look at each week where we actually are seeing a decline. We saw a real spike up in mortgages, and then last week it was positive but really came down, and now it's actually starting to turn negative. All right, then this is put up by Real Investment Advice. This is CEO confidence, and it goes pretty much hand in hand with what the S&P does. Now this is looking annually. This is going all the way back to 1990. So you can see, feeling good, the market goes up. Feeling not as good, market tends to go down. Then, and this is why I'm a little bit later recording today's video. Man, those Chinese kids know how to party. I do teach English online to Chinese children, and this was their new year. It's the year of the snake. So, what does that mean for the stock market? People like if they can try to take one bit of information and put it with what the stock market does, like the Super Bowl indicator and who wins the World Series and what the planets are doing and whatever, okay. So, going back and looking at previous years of the snake, the average is up 0.8% because that's Chinese culture, and the stock market is pretty much US culture, even though the Chinese market has become more relevant these days. And the median is 2.5%, and it's 50-50. So, hey, you flip a coin to see if we're going to be up or down. All right, equity net long positioning, the S&P 500, and then this is comparing the Nikkei over in Japan. And then you have the emerging markets and those which are, what was it, the beginning of 2023. There was a real push into emerging markets, but that didn't seem to last very long. But these are more leveraged here. And folks are still, even though we've been going down with the S&P, that's where we see most of the liquidity with a lot coming into Japan right now. Risk appetite still pretty high, but not necessarily extreme. And then the large cap, how much they're going to spend. And these are the big companies, Amazon. And this is positive, I would think, for the economy because if they're looking to spend money out into the future, or here's Windows, Google, well, I don't know what this one is, and all of them together, they are really looking out and still wanting to spend money. And these are the big companies that really drive tech and to a large degree drive the economy. Maybe some of you could, I don't know, is this Nvidia? I, all right. The dollar's been heavily correlated with U.S. growth stocks. I go over this in the intermarket analysis video over the weekend. But I use it as it relates to the S&P 500. This looks at the Nasdaq itself, and you can see if the dollar is stronger, then the Nasdaq tends to do better, which is kind of the opposite of what we've been seeing lately, because the market's usually like a weaker dollar. That makes their books look better, the conversion rates are more favorable, but you can see longer term here, at least going back the last couple of years, there's a pretty strong correlation between them. All right, and then the financial conditions, we are seeing them going down, and that can help the market to go up. That just means money's more available, interest rates are considered more friendly, and a lot of that money ends up finding its way into the stock market. And when you take out stocks, it's been coming down, but it's starting to tick back up here. All right, then European stocks are outperforming the US. We've got Germany setting all-time highs right now. Even though in yesterday's video I showed how the big high-flying stocks in Europe are really underperforming the Magnificent Seven stocks here in the US. Well, that's one thing, but this is just showing lately anyway how Europe has really been doing pretty good. All right, and then we expect two 25 basis points cuts this year, and then one in 2026. And then it's hard to know the exact timing of future cuts. And this is Goldman Sachs. They still think that there's going to be more rate cuts coming into the future. All right, I didn't spend any time on Twitter. I was too busy partying with the Chinese kids. Here's the intraday chart here where we did have a lower open, and this is the daily pivot, the dark blue line, and we hung out above it there, a little bit choppy. And then we did break down. This is before the announcement. We came down to S1, but then quickly came up. We kind of settled underneath the daily pivot. And then we started to go down. This is when the announcement came out. But then we came back up and stayed right around the daily pivot and closed below the daily pivot. Then our intraday chart, not much of a change in the initial overnight session. We were pretty quiet here with the initial overnight session for Wednesday and saw a little bit of a pop as Europe was going up. And then here's while the market was open. And we're still looking good here, though. The intraday chart of growth versus value shows the blue line above the red line. And that's what we want in a more positive environment. And we really dropped in Monday's session with the growth to value for the S&P, but it is trying to make a comeback now. End of day, we were down more with growth than value. We were down more with growth with value for the mid caps, but down less with the small caps. So even though we took a bit of a hit here, we're still looking okay. When we look at small cap growth to value on the end of day chart, mid cap growth to value ticked down a little bit, still looking good though, and still looking pretty good now with the growth to value ratio for the S&P. And came up a little bit more to the upper end of the rainbow now, even though we declined when we compare the growth versus value ETF. The discretionary to staples ratio still looking really solid here. That's positive. Large cap growth, it was down, but still above its 50-day moving average. As far as our trend, we're just continuing to go down with the ADX. That means we're not trending right now, and it's still weakening. There's really not much that has happened to get the trend back stronger. We are positive because the green line's above the red line, but the green line's going down, but the red line's also going down. And that same thing here in the short term. Green line on top, weakening, non-trending environment. Volume was above average there. And then we did get the latest reading from Investors Intelligence. Still not really feeling all that positive. 1.61. We usually pay attention to this if we get above 3 or below 1. They're kind of considered neutral right now. The VIX, not much of a change there. We were up just a little bit on a closing basis, and not much of a change with the bar chart, and coming down just a little bit here with the VIX of the VIX to the top moving average. The momentum is still down, but the MACD is turning back up, but it has not crossed above its moving average yet. Still getting a high reading from the skew index, even though it is dropping from that extreme reading. The market's still expecting some kind of a big move, but we've been in this red area for quite a while now, and that move seems to be elusive at this point. We ticked up with this fear gauge. We also ticked up with the other fear gauge. So a little bit of confirmation there is a bit of fears creeping back in. We're going back up after getting extreme negative here with our 5-day equity put call ratio. And going up tends to be negative. That means there's more hedging going on. But when we get a real low reading like this, that means that's positive for the market. But so we'll keep an eye on this one. The daily chart continues to go up, and then I provide a longer term look at the 5-day chart here just to give you some other context for when this was giving us really low readings. Even though it could go lower than it is, it's starting to go back up now. And the 10-day chart is also going up. So we're seeing a bit of a confirmation there as a bit of hedging is starting to come back into the market. And we actually declined, though, with the volatility risk premium. We came up to the band here, and then we're starting to go down. That just means fear, according to this, is low going out 30 days. Advanced decline line did decline here a little bit here, but we're still positive. We came down a little bit based on price and volume, but still above the longer-term moving averages. This is one of the ones that we've been watching, getting a very high reading with the advancers minus decliners and then taking a 10-day moving average of that. It turns that into an oscillator where we look extreme positive or extreme negative. We've been getting very high readings here. Now we're starting to come down below this 100 level. And there are times when we top out and start to come down, we go sideways, and then we saw a bit of a decline here. This, we top out, start to come down, and then we declined after that. Saying a similar thing here. So we just want to be aware of this. But we're still looking good internally. New highs are exceeding new lows, and we're going up with the 5-day and 10-day chart. We declined a little bit here with the advanced decline ratio on the short and intermediate term. This could be getting a little extreme. This is our first smart money indicator, accumulation distribution, because we're getting kind of far away from this moving average. Don't pay attention to that boom indicator behind the curtain there. But we're still looking good here. The chicken money flow. We're going up with the red line. The histogram declined a little bit, but we're still looking positive that way. And we're getting even more extreme with the chicken oscillator. So we have 2 out of our 3, accumulation distribution and this chart, chicken oscillator. They're looking extreme, but positive, where the chicken money flow is still looking pretty good right now. The vortex, this is a welcome improvement if you're more positive on the market. We went back up with the green line and down with the red line. This was causing some concern. Even though we were positive with the green line above the red line, the green line just kept coming down. So to see this bounce back up is somewhat positive. Looking at the cumulative advanced decline line based on price for the S&P, not much of a change. A little bit of a decline here based on volume. Came down a little bit when we compare the S&P to the NYSE advanced decline line. 2 separate ways, because the S&P is more specific, the NYSE advanced decline line is more general. But that came down as we were down just a little bit here with the S&P 500. Longer term, though, this is improving and has been improving over the last number of days. This is an internal measure, longer term, 10-day average of the highs and lows for the S&P. It continues to go up. If we get above this green line, number one, that could be considered extreme positive, but we spent a lot of 2024 above this green line, and that could also suggest good longer-term momentum is positive. And then looking at the cumulative advanced decline line for the NYC, came down a little bit, but still looking pretty solid. Came down with the regular NYC advanced decline line, but still above the moving average. We're also declining, but above the moving average with this other NYC advanced decline line. We break it out based on common stock, looking at price, a little bit of a decline based on volume. A little bit of a deterioration here with the advanced decline line studies, but we're still above the moving average with the NYSE common stock, the S&P, the mid caps. Small caps are starting to come back down and actually dropping slightly below the moving average. This is another broad market longer term measure where we look at the 5 period moving average of the highs and lows. We're still positive there. This is another one we've been keeping a close eye on. Those stocks in the S&P above their 20 period moving averages, giving us very high readings when we go above 80. Now we're still above 70, but if we drop below 70, that could mean things are turning a little weaker. Because you can see when we go above 70 and then what the S&P does after that, it's usually good things. Also seeing a decline here with our 50 period moving average study, but still above 50, so it's still positive. Also declining with the 100 moving average study and the 200 moving average study. This is when I say weakness developing, this is what I'm talking about here. It's more under the surface. Here's the short-term chart. It's hard to see because the pivot point is in here. We're getting ready to start a new month, and they're already calculated for February, so it can get a little obnoxious here. We're still above the 50-day moving average, and we are slightly above average with volume. But we're coming down a little bit here with the 20, 50, and 200 period moving averages on the S&P. A little bit positive with the Stochk RSI, but when we're really moving one way or the other, this indicator tends to get extreme positive or negative. Since we're above the midpoint, though, it's slightly negative, but it did decline. And we're no longer extreme with the Williams percent are. The CCI 14 and the CCI 20, kind of the same thing. They're above their midpoints, but when we really show more short-term conviction, these start to go extreme positive. And the stochastics in the short term no longer extreme positive, no longer extreme in the intermediate term. Where we're extreme is a longer term stochastic. We're above this green line, but this is starting to roll over. We decline, but still positive with the force index. The condition of the short term trend is measured by a double and triple exponential moving average based on 20 periods. We're right in between the two, actually dropping down just a little bit below that. But we're still above the simple and exponential moving averages based on 20 periods. That's why the short-term trend is still positive. With the standard deviations chart, we're declining, but still above the midpoint. So that's still leaning positive there. The balance of power, it's continuing to go up, and it's above zero. So it's positive, and we're kind of loosely positive here with the go, no go. Dark blue, that's positive. When it changes to light blue, that's like, uh-oh, we don't like what's going on here. Still above the midpoint with our highest high value chart. The TTM squeeze continues to go up. Now be aware, we're getting close to this black line, but I put the black line on here. But when we get to the black line or above, that means we're getting extreme positive. And when that happens, I have a longer term version of this chart that I'll show to give you more perspective. Standard deviation really coming down as we've been chopping around over the last few sessions, but still above its moving average. The ease of movement, which had turned negative, is now switched back over to positive, and this tries to measure the path of least resistance. Is it up or is it down? The Erin just kind of sleeping here. It really hasn't reacted to much of anything that's happened this week. It's positive since the oscillator's above zero. This is another thing we're watching, is the McClellan oscillator for the S&P, giving us a very high reading, coming down. Sometimes that marked a reversal, sometimes a little bit of a slowdown. We'll be watching this to see if we go back up, are we going to create a lower high with this indicator? Are we going to continue to decline? Now it's still positive because we're above zero. And when this is above zero, we're going up with the summation index based on price and volume. But you can see they're slowing down a little bit here. And then the NYSE McClellan oscillator, the same thing, declining after giving us an extreme reading, but still above zero. So we're continuing to go up with the summation index based on price and volume for the NYSE. This is the one that's been a warning since last Friday, the Swenlin trading oscillator. It's not a primary indicator because sometimes it gives us false signals, but it's been saying the same thing for what, 4 trading sessions now. We've been declining based on price and volume. And I tend to look at the direction of what this is going or how this is going, and then it'll turn even more negative if we drop below zero. But momentum is still positive. The PMO still going up. We're still going up based on price and volume. Coming down with the PMOs that are rising after being extreme, coming down and not quite crossing back below with the buy signals, still going up with the PMOs that are above zero. Parabolic SAR is positive with the dots underneath. We're still neutral with the Elder's Impulse system for the S&P. This is the other extreme indicator. This is a short-term oscillator that measures momentum, its slope, and we're above this green line. But it's positive since we're still above the moving average. And then short to somewhat intermediate term is the MACD, a very popular momentum oscillator. That's still positive. And then I have a lot of different oscillators that I plot on one chart. I have two short-term oscillators, which are positive, and then three intermediate-term oscillators, which continue to be positive. And then long-term oscillators, the Trix and KST, they're all still positive. So momentum is still positive across the board now. And then another momentum oscillator, the Copic curve, is positive, coming down a little bit, but in this initial green area with the Sean trend meter, and above 50 though with the money flow declining, but still above 50 with the ultimate oscillator. Now this chart, money flow and ultimate, they're secondary. I just use them to confirm what I'm seeing with other charts. On balance volume, the only reason I follow this is because there are so many indicators that we look at get their values starting from on balance volume. We're still positive here since we're above the moving average. Still above 50 with the RSI 14, that's more intermediate term, and also still above 50 in the short term RSI 9. And this is a signal that got generated before we started going up. It's the Pring bottom fisher, and it's still generating a buy signal. This is the mass index. Criteria number one, above the red dashed line. Criteria number two, above the blue line. Criteria three, when it comes back below the red dashed line. Whatever happened to create this, which probably means we were going up, this is suggesting that there may be a reversal, which would mean we continue to go down. Now, we don't know, and we don't use this chart all by itself. We use other charts to confirm what we're seeing here. The condition of the intermediate term trend still looking okay. We're above the blue line here, and the red line and the blue line are still going up. All the moving averages were above all of them. And so that's why we're positive in the short 20 periods, intermediate 50 periods, and long-term 200. I also throw the 100 in there because it became pretty important. Earlier on, this was a major level of support that held. This is a little bit of a concern too. The bullish percent index did decline. Now, we've been going up and we're still above 50, so it's still positive. But if we continue to drop, this is showing that there's an increase in the number of point and figure sell signals that are increasing inside of the S&P 500. And still doing okay, not much of a change here with the NYSE bullish percent index and a teeny tiny little bit of a decline with the NASDAQ 100 bullish percent index. And this is a longer term trend line that we've been keeping an eye on going back to 2009. We're hitting the upper end of this. And I keep asking the question, will this provide longer term overhead resistance? So far, it's been happening. We go back to December when we hit this, came down a little bit. Now we're kind of dealing with those areas again. And we're still seeing more of a doji look where you have the open and close pretty much equal with each other. That's what we saw after Tuesday. We see the same thing after Wednesday with a little bit more of a negative slant now because of this dark black candle here. But we're still positive with the Kegi chart. We're black and pointing up. The Renko chart is still positive, and the three-line break is still positive. Long-term declined a little bit here with the 150 and 200 period moving averages. I have the 50 on here, but I mainly just use that for more intermediate term context, where this is supposed to be a long-term chart. And we're negative with the NASDAQ 100 in the short term. All the other indexes, the S&P mid caps and small caps, are still positive. And we switch back to positive with bonds based on price in the short term. Commodities are screaming higher right now on all time frames. The dollar's still in a short-term downtrend. And we saw a lot of defensive areas, but the area that really shined were communication. That's a growth area, and it led things higher. So that's positive. But staples and energy, when they're concerned more about inflation and can be considered more of a defensive play, and utilities could be a growth area now with all the EVs and AI and what other acronyms they're coming up with. Those were positive. All the other sectors ended up being down on the day. And we saw a nice little BPI cross above 50 with the NASDAQ. That's positive. And that was right at the open. And then everything else was red, or we dropped below 19.6, 19.6, 19.5 with the NASDAQ. We had a bearish MACD crossover. So we're seeing a bit of a conflict there. Now, this was at the beginning of the day. The BPI cross positive. The MACD crossover, that's negative. Energy had a MACD crossover negative as well. All right, and then seeing a little bit more of a decline here when we look at the equal weight versus the weighted version of the S&P. So the broader market was a little bit weaker. The Dow was down, but still above this pivot point here, still above its 50-day moving average, and it's still neutral with the Elder's Impulse system for the Dow. Hard to see here with the pivot points on the chart with the NASDAQ because we have the new ones coming in for February, but still above its 50-day moving average. The same thing here, just a little bit above its 50-day moving average with the NASDAQ 100. And this is kind of interesting, where we went from negative to neutral back to negative with the Elder's Impulse system for the Qs. And the momentum weakening, but still positive for the NASDAQ 100. This is another one that so far is holding up. These are the QQQs still coming in above their 20 period moving average and also using the 50 period moving average as support. So this is positive. This support level is holding. We'll see if it can hold on to that and bounce back up, or if we drop down below that, that's going to be more negative. Small caps just really under their 50-day moving average, not really moving these days. Same thing with the Russell 2000, small caps still above 50 with the RSI, but declining. Momentum is still positive, but we cannot seem to get above the 50-day moving average, and now we're starting to drift down further below that. And we're neutral with the Elder's Impulse system for the small caps. Mid caps closing slightly below their 50-day moving average. We were more positive here since we were above it. Since we're a little bit below it, that's slightly more negative. We're still neutral, though, with the Elder's Impulse system for the mid caps. The Wilshire, this is a broad market measure. We were down, but still above the 50-day moving average. We were down with the total U.S. stock ETF, but still above the 50-day moving average. The bank ETF is still holding out above its 50-day moving average. That's positive. And the financial sector was virtually unchanged above its 50-day moving average. We want the financial sector in general, and then the banks specifically, to do well. That's one part of the market. When they're looking good, the rest of the market is more healthy. The FANG index, the really big companies, we were down 1% there, but still below the 50-day moving average and still in an uptrend. And we came all the way down to this longer term trend line, bounced up off of that. We have not come back up to this shorter term trend line with the FANG index. So Apple was up almost 0.5%, dealing with its 50-day moving average. Amazon down 0.45%, still coming off of an all-time high. Google virtually unchanged, kind of chopping sideways right now. Meta, which reported after the close, up 1/3%. Microsoft down over 1%. Still above its 50-day moving average. Nvidia down 4%, a little bit above its 200-day moving average. It's like, okay, it fell down, went into a bear market for one day, bounced back up. Now it's seeing some weakness. There, from what I understand, there was Alibaba, which is a Chinese company, kind of similar to Amazon.com. They came out with their own version of an AI model, and that might be freaking Nvidia out a little bit here. And then Tesla, which also reported after the close a little bit below their 50-day moving average. Netflix coming off of a recent all-time high, looking a little bit better there. Semiconductors, again, this is an area we thought we were breaking out above these previous highs. Nope, we're coming back down to the 250-day moving average. We're still above that, even though we declined on Wednesday. We're seeing if this level will end up holding as support. And we look at a little bit of a drop off, but still a strong relationship between US and international stocks, also leveling off longer term. Oil was down, getting further down into the 70 range. The dollar was up, and according to what we saw earlier, it's a short-term downtrend. I still have us in an uptrend here. I use a moving average crossover, and it's just a 50 over a 200 period moving average. So we're back up into the high 107 range. And we were up slightly with the 10-year yield. We were down slightly with the 10-year based on price, coming right down to its 50-day moving average with this ETF. We've been keeping an eye on this. The ratio between home construction and the 3 to 7 year bonds really falling off, trying to recuperate a little bit here. Now it's starting to go back down. And keeping an eye on the 10-year yield in Japan, it actually declined. But if it really starts to go up, that could possibly reproduce what we saw last summer with the whole carry trade that bled over into Europe and then into the US, and things were the end of the world was there. That lasted a day or so. And we moved on. Just like last Monday was the end of the world. Well, here we are on Thursday now. Looking at our growth to value ratios, coming back up, it's still below the moving average with Qs to S&P. Discretion at S&P still above its moving average, and we're coming back up to a declining moving average when we compare large cap growth to large cap value. So up to the moving average with the large caps, still looking pretty good here with the mid caps, coming back up to the moving average with the small caps. All right, what's our outlook? Earnings season, and I tried to change this. I had Amazon on this list. Apple's going to be reporting on Thursday, another big company, and that ends up being about 40% of the market capitalization of the S&P. We're positive, but we are seeing some weakness. Now, this could turn around, and Wednesday was a Fed day, and that's kind of its own crazy little day in and of itself. But we're pulling back, but is this going to develop into something more negative? That's really what we're watching right now. We're going to get jobless claims, GDP, the first look at the 2024 number for the fourth quarter. So we've never seen this before, and this has an inflation component in it, and then pending home sales as well, and then all the geopolitical things going on. It's going around so fast that even the news folks can't keep up with what's happening, especially with the new administration. And then on Friday, we're going to get core PCE, another major inflation report. And here's a look for Thursday with the economic reports coming out. Seasonality neutral to negative, kind of leaning more in the negative side here for January 30th. But we're positive here in the post-election year, according to the Stock Traders Almanac. We're still looking okay here, but then it tends to go down a little bit as we head into the last day of January. And this is longer term out for the whole year, depending on, okay, is this the fifth year of the presidency? Well, it's also the first year the incumbent party lost. And so that's another line that they have here. And we're mainly just focusing on the January area. Probably what I'll do after this week is I'll switch this one over to the weekly video because this is much more longer term. And coming up here still in the second half, just keep an eyeball on the first half of February. I haven't marked it here. It tends to perform fairly well, but we get into the second half of February and it's not so good. So it ends up being more weak on a seasonal basis going back to 1950. Small caps just not doing what they historically do right about now. Now they can still catch fire. This whole run up goes up into March, and we're just finishing up January here, but it's just not doing what a lot of folks had hoped it would do. And then coming up into the end of January here with Tom Bowley's research, this is still a positive seasonal time. So the warning signs, we're going up with the equity put call ratio based on 5 and 10 days and the Swenlin trending oscillator. Now, a lot of times I just dismiss this, but it's been consistently negative since last Friday. So that's why I'm putting a little more emphasis. It's also in yellow because that's not a primary indicator, but it's a little more important than a secondary indicator. Then the positive side, we're still looking pretty good here with our smart money indicators, but maybe a little too good with accumulation distribution and the Chaikin oscillator. The growth to value ratios and discretionary to staples, they're still looking pretty good there. And the advanced decline lines were positive, but there was some weakness. The ease of movement has gone back over to the positive side, and the McClellan oscillators and summation indexes for the S&P and NYSE seeing some weakness there after giving us some extreme readings, but that could turn around. But if it continues to develop, it might be more of a warning sign. But they're still positive for now because the summation indexes are going up and the McClellan oscillators are above zero. We're still positive with the momentum. The parabolic SAR is positive. The bullish percent indexes are positive, but coming down a little bit. Not quite dropping below its moving average yet on the S&P, but still more weakness might suggest things are turning more negative. The vortex is positive and actually improved a bit on Wednesday, and our moving average studies are positive but coming down right now. But we're still above 70 with the 20, and that's suggesting good short-term momentum. The money flow and the ultimate oscillator, those are secondary indicators which are positive. The financial sector is positive, and the momentum for the NASDAQ 100 is positive, but rolling over a bit, but it hasn't turned negative yet. So, our conclusion, we're still positive, but there's potentially some weakness starting to flow into the market. In the short term, this is where we're seeing a lot of that weakness, and we're still a little bit overbought in the intermediate term. It's coming back down a little bit, and we want to see if that short-term weakness continues, is that going to bleed over into the intermediate term? But we are still positive in the long term. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.